If you've been watching the news recently, you're probably aware that there's a lot of talk about recession. Are we in one? Is there one coming? How long or how deep might that recession be? And if you're considering retirement, that may be getting your attention even more so. So let's talk about that. What do economists think is really going to happen? Well, it depends on which economists you talk to. Bloomberg has a panel of economists, and recently they said that the chance of recession in the next 12 months has risen from 60% to 65%. The people at the conference board are even more confident that a recession is coming sometime between now and 2024. They're 99% sure, according to their statistical model, that a recession is on the way. However, the people at Statista who do a statistical model of the likelihood of recession, their model would say, well, the likelihood of recession has actually diminished a little bit over the last month, dropping down to about a 55% likelihood between now and 2024. So who's right? Well, that's a great question, and we'll know after the fact in terms of whether these predictions are accurate or not. The thing that a person thinking about retirement or worried about a recession has to ask themselves is, do they want to make financial decisions based on these kinds of predictions? Now, why are we in this boat? Well, one of the reasons is because inflation had been running relatively high starting back in 2021 into 2022. And so the Fed took action to try to lower inflation. Inflation reduces our purchasing power as individuals, and that's usually a bad thing. So the Fed is trying to slow the economy by raising interest rates, causing that inflation number to moderate and hopefully to fall. Recently, we've seen some signs that they're being successful. If you look at this chart, it shows a lot of different measures of inflation actually going down, and some of them pretty significantly. The only measure of inflation that's not declining significantly is the employment cost index. It kind of makes sense because the unemployment rate is still relatively low. A lot of people looking to hire still, and so that employment cost index has been sticky. Question is whether or not we'll see that decline a little bit as well as the Fed continues to raise rates. These inflation numbers are falling, and that makes sense because as interest rates rise, the costs of borrowing are going up, the costs of consuming are going up. So if you think about if you had to finance a house using a home mortgage, finance a car borrowing, if you're a business and you're doing a capital project that requires you to borrow money, all of those things cost more money because the interest costs associated with them is now more. So fewer people can afford to do those kinds of things just because of the expense. You want a practical example of that? Think about buying a house. Mortgage rates in 2021 are about 3.2%. They're currently 6.2%. That means that a price of a house, or the cost that you would pay monthly for that mortgage, has changed from $432 a month to $619 a month for every $100,000 that you finance. What that means for most people is they can afford to buy less house. It also means that there's price pressure on houses. So those housing prices are actually starting to decline. The Wall Street Journal reported last week that home prices saw their biggest annual decline in the last 11 years with the March data. Sales fell for the 13th time in the last 14 months. So it appears like the Fed is actually getting what they want. They're slowing the economy a bit. So recessions come about because of slowing economies. According to the History Channel, using the definition of 2 consecutive quarters of declining GDP, the U.S. has had 13 recessions since 1945, lasting an average of 10 months. That's a recession about every 6 years. So what does that mean for the economy if we go into recession? Well, usually you have rising unemployment because corporations are seeking to reduce costs. That means corporate earnings are generally going to go down initially as well. Inflationary pressure could lessen because people are consuming less. Demand is going down, which also allows the Fed to either pause or maybe lower their target rate in terms of that interest rate activity. So then what happens to investment markets if a recession were to materialize? Well, in this one, it's likely more of the same. Stock markets are volatile all the time. The likelihood is they're going to stay volatile as people try to understand what's going to happen next. The good news for us right now in terms of cash and bonds is current rates, now that they're higher because of the Fed's rate raising activity, we as investors are getting paid more for holding cash and bonds in our bank accounts, money markets, and bonds that we might buy. There's kind of a double win here. If the Fed actually has to lower interest rates because the economy were to go into recession, not only do you get to keep the higher interest rates of the things you own right now, but the price of those bonds would likely rise as well, because generally as interest rates fall, the prices of existing bonds rise. But the uncertainty that we experience, well, that's not going to change. Uncertainty is the case all the time. The idea here is bear markets can occur. So if you're worried about stock markets, bear markets can occur with or without a recession. So how do we prepare for a potential recessionary environment? Well, the way to prepare for a recessionary environment is have a great financial plan and a portfolio based on your unique circumstances. Here's the takeaway for those considering retirement and worrying about recession. Recession is really not the actual threat. The depth and length of a bear market, whether it's associated with a recession or not, compared to your portfolio's liquidity and the other cash flow needs that you need, that's the stuff that should really get your attention and our attention as well. Ben Carlson, who has a blog, he has a helpful table to describe the round trip of a bear market. And what he means by the round trip is, if you think about the market, the stock market, from the peak to the trough to the full recovery, that's the round trip. This chart shows the longest bear markets in terms of round trips since World War II. And you can see the longest one is the dot-com crash in the early 2000s, lasted 79 months. When we're thinking about our retirement spending, it's that round trip time frame, 79 months, that should be the primary focus for your portfolio's retirement readiness. For example, if you'll need $60,000 a year from your portfolio, that's $5,000 a month, and you wanted to cover the round trip worst case for the U.S. stock market since 1945, you'd want to have an excess of $395,000 in cash and high quality shorter term bonds to make sure you didn't have to sell any stock investments before a full market recovery. That's 79 months, the length of the dot-com crash, the round trip multiplied by your cash needs of $5,000 a month. Now, if you can hold stocks for 10 years or more, the likelihood of getting the benefit of compound returns akin to historical averages goes way up. And by holding adequate cash and bonds to cover all your planned withdrawals during one of these bear market round trips, it just raises the chances that you're going to be able to hold those stocks, not have to sell them for any reason during an extended bear market. Now, I like this quote. If you spend 13 minutes a year trying to predict the economy, you've wasted 10 minutes. I'm not sure you really haven't wasted all 13. Instead of thinking about what the economy may or may not do, what the likelihood of a recession is, it would be much better, in our view, for you to spend many minutes, even a few hours, building and reviewing your long-term financial plan. This is the key driver to use to assemble a portfolio that will help your plan succeed during a recession, no matter when it arrives. The likelihood for most investors is that they will see multiple recessions during their investment lifetimes and likely multiple recessions even during their retirement years. Recessions, while hard to predict the precise timing, should never be seen as a surprise. One of the things we would recommend is, if you haven't done a financial plan to this degree, looking at your cash flow over the next 79 months or longer, we think that's the place to start in terms of developing your portfolio strategy. If you are a client of Foster Group and you'd like to review your allocation to make sure there's enough cash to survive something like the dot-com crash, we'd love to have that conversation. If you're not a client of Foster Group, this is where we start with most people in terms of talking about, hey, is my portfolio set up to endure, to survive and thrive a recession? We'd love to have that conversation with you as well. So thanks for watching today. If you have other comments or questions for us here at Foster Group, there is some contact information on the screen here. We'd like to answer questions that are on your mind. That's kind of the purpose of these Financial Perspectives videos. So give us some information, let us have some feedback, and we'd be glad to address those questions in the future. So hopefully we'll see you in a couple of weeks. Until then, be well.